Welcome to the deep dive. Today we're really getting into the engine room of the market. We're looking at this pretty compelling idea that what really drives prices isn't news or sentiment, but something more fundamental: money flows.
That's right. We're digging into research shared by our listener from an investment firm's report, Best Growth Stocks for October 2025. And the whole mission here is to unpack their specific method. They argue that algorithms can spot consistent capital inflow, and that's the key predictor of explosive growth.
Yeah, and just to be clear, we're not here to give investment advice, not at all. The idea is to give you a kind of shortcut to understanding how this firm thinks and why they're putting so much weight on this system. We'll explore the main concept, talk about the data signals they track, and then look at three specific stocks, three very different companies actually, that their algorithms flagged as having, quote, relentless inflows.
Exactly. We're analyzing the data they present, looking at the framework underneath it all, helping you understand what might be driving some of these, frankly, pretty remarkable market moves.
Okay, so let's set the stage first. The source material really paints a dramatic picture. If we rewind just 6 months from when this report came out, well, the mood was apparently pretty bleak, fearful even.
Investors were supposedly bracing for, I think the term used was a dark age of capitalism, really worried about global tariffs just slamming the brakes on everything.
But then the data told a completely different story, right? That's the fascinating part. Instead of the crash everyone feared, we got what the firm calls an unthinkable crowd-stunning rally.
Yes, and they claim this rally wasn't a surprise if you were watching their flow data. It flew in the face of the narrative, but not the numbers.
And the scale of it was, well, significant. The S&P 500 jumped 36% off its April low. That's big. But the NASDAQ 100, the tech-heavy index, a, quote, mind-numbing 47% gain in just 6 months.
47%. It really does challenge conventional thinking about market speed.
So if it wasn't specific news or Fed policy driving this, what was it?
Well, according to this methodology, you're looking in the wrong place if you focus on those things. They argue these kinds of violent moves, up or down, are fundamentally driven by money flows. Simple as that. When serious money is consistently pouring into stocks day after day, mathematically, prices just have to go up.
So the core idea is, forget the headlines, forget the punditry, just watch where the big money is consistently going. It's all about that sustained buying press.
Precisely, and that feeds right into their be early philosophy. If their system can spot institutional money starting to move into certain assets consistently before it hits the mainstream news,
then you get to ride that wave.
that's the idea. You capture these incredible returns quickly because you're aligned with the incoming capital tide, not just reacting to old news or trying to perfectly time fundamentals.
Okay, powerful idea. But the big question is always timing, isn't it? How do you know when that wave is actually starting? The report says the signal isn't good news, surprisingly. It's peak fear.
Peak emotional failure. Yeah, they talk about extreme capitulation, that point where everyone is just throwing in the towel, selling not because a company's bad, but purely out of fear. Panic selling.
Emotionally driven selling, basically.
Exactly. Forced selling that just ignores any underlying value.
And they saw a specific marker for this just before the rally.
They did. They point to the period leading up to that April low. Apparently, it saw the single largest day of net outflows from stocks since the COVID crash back in March 2020. They use that as a framework.
Wow. So that level of panic selling, that psychological breaking point, that's the green light for their algorithms.
That's what the data apparently signals. Maximum fear creates the best buying opportunities. It's completely counterintuitive, right? The moment everyone else is running for the exits is when the data says, okay, now the unthinkable rally might be starting.
Let's clarify this inflow signal term, though. It sounds important, but what is it technically? It's not just high volume, is it?
Good question. No, it's more specific than just volume spikes. When the report says an algorithm detected an inflow signal, it's flagging sustained accumulation patterns. Often high volume, yes, but consistent. We're not talking about, retail buying small amounts.
Right.
These are algorithms designed to track potentially large, maybe non-public trades, perhaps in dark pools, places where significant institutional money might be building a position, sometimes quietly, over days or even weeks.
So one signal isn't just a blip, it's a confirmed instance of concentrated buying pressure.
Correct. A non-trivial instance. And it's the consistency and frequency of these signals together that defines what they call relentless inflow. It suggests real conviction from the big players.
Got it. That makes the concept much clearer. Okay, let's see how this applies in practice. The report highlights three companies. First up is Iron Energy, ticker IREN. This is apparently number one for sustained accumulation pressure.
Right, iron. This one definitely sits at the more speculative end. It's about a $16 billion market cap company, primarily renewable energy, but the key here is it's heavily tied to, well, two very hot and volatile themes: Bitcoin mining and AI infrastructure.
Okay, high growth, high risk potential there. And the performance, the report mentions a 480% surge in just 3 months. That's huge.
It is staggering.
How much of that is just crypto going up versus these specific flows they detected?
Yeah, that's the correlation versus causation question, isn't it? The firm's argument is, yes, the sector narrative, Bitcoin, AI, provided the story, but their flow detection provided the timing and confirmation of the move's strength. For Iron, they say their algorithm spotted 33 separate inflow signals.
33.
33. Starting back on June 9th, when the price was around $10.34, and it was that constant, concentrated buying pressure, they claim, that pushed the shares all the way up past $60. The flow basically overwhelmed the sector's inherent volatility.
And what's the forward-looking story that supposedly attracted all that money?
It's all about the growth forecasts. For 2025, sales were around $495 million, net income $87 million. Okay, but the institutions piling in were clearly looking at 2026 estimates. Revenues expected to more than double to $1.16 billion, and net income projected to jump significantly to around $228.7 million. That anticipated leap in profitability is the fundamental bait, but the flow was the trigger.
Okay, let's shift gears from speculative growth to something maybe more foundational. Stock number 2 is Bloom Energy, ticker BAE. This one connects to infrastructure needs, right?
Exactly. Bloom Energy, a $20 billion market cap company. They make modular power generation platforms, and their big angle right now is powering data centers. There's this huge, almost desperate need for more reliable, scalable power for all the AI and cloud computing growth.
So a much more tangible need compared to iron, perhaps.
You could argue that, yes. It feels less speculative, more tied to essential infrastructure build-out.
And the firm uses Bloom to make their point. Don't fight the flows. What did the data show here?
The accumulation was reportedly quite strong. 21 recurring inflow signals were flagged in a fairly short period. They pinpoint the buying starting around June 30th at about $23.92 a share. Following that steady pressure, the stock more than tripled, hitting $87.58.
So, similar flow pattern, but maybe a different type of investor attracted to the infrastructure story, more long-term focused.
That seems plausible. The Bloom narrative revolves around necessary utility expansion, long-term contracts, potentially. That often appeals to steadier institutional money. And you see it reflected in the financials they highlight. 2024 sales were $1.47 billion. The flows seem to be pricing in the 2026 projections. Sales heading over $2.17 billion, and crucially, net income expected to turn positive around $145 million.
Turning profitable after heavy investment. That's often a major turning point.
A huge psychological milestone. It can unlock a lot more institutional capital that might have rules against investing in unprofitable companies.
Okay, interesting contrast.
Yeah.
Now, the third stock takes us somewhere else entirely. AeroVironment, AV defense sector.
Yeah, AeroVironment shows this flow phenomenon isn't limited to just tech or energy. This is a $20 billion market cap defense contractor. They specialize in things like advanced drones, laser systems, high-tech defense.
And the angle for flow strategies in defense, predictability.
That's a big part of it. Government contracts tend to provide a clearer, more predictable stream of future revenue compared to, say, consumer tech. That reliability can be very attractive for generating consistent flows.
So what did the flow signals look like for AV?
The report notes 16 distinct inflow signals detected starting June 25th. The price then was around $234, and the result of that buying pressure, which, again, the firm emphasizes was happening while conventional analysis might have been looking elsewhere, was a pretty swift 73% gain. Shares went above $407.
So it really drives home the point. The biggest gains don't just chase the hottest sector. They follow the conviction wherever that concentrated capital shows up.
Exactly right. And that conviction for AeroVironment is backed by what the source calls a healthy growth forecast, driven by rising global defense spending, presumably, looking at their numbers. Fiscal year 2025 sales around $820 million, net income $43.6 million. But the flows are anticipating the fiscal year 2027 estimates. Sales projected to surge to $2.3 billion and net income climbing to $122 million. It's that long-term government-funded trajectory the flow seems to be lashing onto early.
Okay, let's pull this all together. We've looked at iron, speculative energy tech, Bloom Essential Data Center Infrastructure. AeroVironment Stable, Predictable Defense. Three very different businesses, but the report argues they all rocketed higher because of the same underlying mechanism. Measurable, consistent buy pressure detected by algorithms.
And that really is the core takeaway the firm wants you to get from this analysis. Fundamentals matter for the long-term story, sure, but for driving these rapid hyper-growth moves in the shorter term, they argue it's primarily about the money flow. That constant buy pressure is the engine. Their mantra sums it up: don't follow the news, be early next time, go with the flows.
Now, having said all that, we absolutely need to add the necessary context here. We've been analyzing the methodology and the data, as presented by this firm, based on information they had at the time.
Yes, crucial context. And we have to state the standard, but very important disclaimer that always accompanies this type of analysis. Investment values go up and down, often wildly. Past performance, like the examples discussed, is absolutely not a reliable guide to what will happen in the future. Future returns are never guaranteed.
And you should always seek professional, personalized advice before making any investment decisions based on any single source of information.
Definitely.
So wrapping up this deep dive, let's just step back for a final thought. The whole system we've discussed is built on this idea that extreme capitulation, maximum fear, forced selling is actually the most potent buy signal.
Right. These huge, unthinkable, crowd-stunning rallies described in the source material literally spring from moments of profound human emotional distress in the market. So, the final question we leave you with is this. If data-driven systems are getting better and better at identifying and exploiting these moments of peak emotional selling, what does that imply about the role of human emotion versus objective data in the future of investing? Is fear becoming just another data point for the algorithms? Is the crowd's panic now the algorithm's best friend? Something to definitely chew on after hearing about this approach.